So one of the main questions that I get is there a way to pay off my loan faster without changing my budget habits? So what I want to demonstrate in this video is three distinct features hidden in a mortgage product that you may not know about. So if you think about how mortgage interest is calculated on a regular mortgage, whether it's a 30-year, a 15-year, or even an adjustable rate mortgage, all of the interest is calculated on the ending balance every single month. So if you think about a realistic example, easy numbers of a $100,000 mortgage balance at 6%, the interest rate is going to be calculated off of that month's average. So if you start with a $100,000 mortgage balance and in the middle of the month make $1,000 principal payment, your mortgage payment is going to be based off of that $99,000 ending balance. So in total, you're going to pay $495 in interest for that month. And each lender is going to have a cutoff of when your principal snapshot is taken to basically determine that ending balance. But you get the idea with this example. Now, if you have an open-ended line of credit, you may see what's called a daily interest calculation. Some traditional HELOCs also take a weighted average, taking into account how often your balance is at a certain level. So in this example, same $100,000 mortgage balance, same interest rate, the ending balance is going to be the same because of that $1,000 principal payment in the middle of the month. But you can see that the lender is taking note of what that daily interest expense is. It will go down a slight bit with that principal reduction. So you get a little bit of benefit for making that extra payment right away. Now, $5 in interest saved compared to a traditional mortgage may not jump off the page. So, with an offset mortgage, which is the third example that I'm going to show you, and a mortgage product that you may not know exists, is the same open ended line of credit as we just went over, but instead of just having that one time principal payment, you can have multiple, and I'll show you how. So this is assuming same interest rate, same mortgage balance, same interest calculation, but this person assumes a bi-weekly payment or semi-monthly payment in income of $2,500. In other words, they make $5,000 net a month in income. So with this all-in-one account, they're able to deposit $2,500 directly against their mortgage so that that daily interest expense is reflected. Then they get paid again on that second Sunday, and they will again reap the benefits of a lower interest expense. Now, this is also assumes two draws. In other words, pulling against the line of credit to pay whatever bills or other debt that can't be put on a credit card. So I'm using $500 here. So that interest expense will go up a tad. Then, assuming everything else is put on a credit card where you can achieve points or get some other benefit for putting expenses on a credit card instead of a debit card, you're going to see this credit card being paid from the line of credit at the end of the month. So in total, the bank is going to say, okay, for 14 days, the balance was this. For 10 days, the balance was this. For 3 days, the balance was this. And then for 3 additional days, the balance was this. So in total, they're paying significantly less in interest for that month. And that continues as the months go on. So I hope this video showed that Even though the ending balance is the same in all three of these examples, this offset mortgage actually saves the consumer a significant amount of interest expense. If this video was helpful, feel free to ask more questions and reach out with your specific scenario. Take care.